Well, joining us now is Joyce Chang. She is JPMorgan's Chair of Global Research. And Joyce, it's great to have you on the show. Welcome.
Great to be with you, Morgan.
I'm going to start right there because he didn't use the word, but he implied the rising risk of stagflation. Is he right to be concerned about that in the comments we heard from the Fed chair this afternoon?
Yeah, I mean, look, we still have the recession risk, even with this 90-day pause, at about 60%. I mean, we see PCE inflation coming towards 4% over the next year, growth flat at the end of the year. Now, it's not imminent. I mean, some of the hard data is still looking relatively healthy, but, flat growth, higher inflation, still very high fiscal deficits. One has to highlight that these stagflation risks are, real risk, and that the uncertainty continues. And I don't think it's over after 90 days. I mean, U.S.-China is going to be an enduring issue, and that's where you have, the tariffs really, at levels where they're going to take a material hit, on the global economy.
Do you think that those trade dynamics between the U.S. and China, to your point, are very, very sticky and sort of represents a new world order here? Or do you think there's really potentially a possibility that the U.S. and China strike a deal, and maybe even strike a deal more quickly than the U.S. does with some of our allies, like the European Union, which we have not been able to get to a bigger, broader deal for a number of years and across a number of administrations now?
Well, I think that the uncertainty is going to continue on U.S.-China. I mean, China has, I think, made it very clear that they need to be shown some respect. They also need to know who the clear negotiator is. And so I think there's a lot to do in the next 90 days. I mean, 90 countries in 90 days. And where we have the tariffs right now, a 10% universal, 140%, 145% on China, that takes the overall tariff rate to, 25 to 30%. I mean, we are talking about a tax hike that's really over 3% of GDP. And I think that both sides have hardened their stance a bit, even though you see some exemptions on just what it would take to get to any kind of grand bargain.
I want to go back to your recession call because you made that, a little over a week ago, week and a half ago. But not all recessions are created equal. So just a little bit of context or nuance in terms of what you would expect a potential recession to look like.
Look, a recession is not preordained. It's not imminent, but what you would need to see to get to the non-recession scenario is that you have the tariffs come down on China, that you don't have further escalation here. So that's why we keep the recession risk high at 60%. But it's less about the call itself than just the negative consequences that we see for global growth. Now, what kind of recession would it be? The starting conditions for the global economy are in a pretty healthy place. So I think it would be a shallower recession, a more traditional recession. This is not something that's akin to a global financial crisis, but we have to point to the downside risks given the way that the tariff discussions have played out.
The economic data, what are your expectations as we finish up Q1 data and we come into Q2? How noisy is it, especially when you think about pull forwards in inventory amid all of the tariff and trade uncertainty right now? And I ask that thinking about some of the transport results we've gotten, where the commentary has been around that.
Look, we've seen a lot of front loading of the data, so you may really not have some of the data really show signs of softening until more towards the middle of the year. What we've seen, though, is a real change in the sentiment indicators. So the soft data is really showing you that plans for future capex and future investment are really being put on hold right now. But the front loading is playing out, and even the China data that came out earlier today. I mean, the first quarter was, somewhat better than expectations. We've still taken the China forecast down. We now have China's growth in the next year at just a little bit over 4%. So I think there is going to be this lag with the hard data, which is why we really don't see the Fed doing anything until September.
You're cautious on riskier assets. What do you consider a safe haven to be invested in right now? We've been having this debate for a number of days on whether the traditional safe havens still hold up in this environment, given some of the behaviors and some of the moves we've seen, for example, in treasuries and in the dollar.
Yeah, no, it was a historic week for Treasury moves. I mean, you had the 30-year transverse 70 basis point range. So, look, I think that some of the safe haven currencies are still the euro, because you're going to have a front loading on the fiscal spending. We still think yen here. We think gold is going to do better. We've taken our oil forecasts down fairly significantly, and the short end of some of the developed market rate side still looks attractive here as well. But I think we have to be prepared for higher U.S. term premium to be a trend that holds throughout the year, particularly as we see higher Treasury funding needs given the fiscal outlook as well. So I don't think the turbulence is necessarily going to go away.